I now request Chairman Mr. S.V. Shastri to welcome the August gathering.
Honorable Governor, Reserve Bank of India, Shri Shaktikanta, other senior functionaries from RBI, guests from other esteemed institutions, associations, partners, members, distinguished guests, ladies and gentlemen. At the outset, let me convey my greetings on the proud landmark of our country having achieved the 75 years of independence mark. It is my proud privilege to welcome you all to this FIMMDA annual dinner being conducted this year in physical form after a gap of 3 years. Today's events mark FIMMDA's first event in physical mode post-pandemic, and I am elated to welcome you all to this gathering. While the pandemic restricted our movement and imposed social distancing on us, it did not deter us from continuing our connect and interactions with each other among various stakeholders through events, conferences happened through the virtual mode. Historically, FIMMDA annual dinners are an endeavor towards networking with other participants, market bodies, regulators, and exchanging views on topics of relevance. It is pertinent to mention here that the important objective has always been the sustained development of domestic markets. There is no doubt that the outbreak of pandemic has impacted our growth momentum. Just as we were recovering from the after effects of the pandemic, the economy was again shattered by the geopolitical developments. India too was affected by these geopolitical developments. The government and RBI have jointly taken steps which enabled the economy to be resilient. It is felt that the current phase of increase in inflation is largely due to external factors, positioning it as RBI, as we all know, is taking measures to firmly anchor inflation. This evening, we are privileged to have with us Governor Shri Shaktikanta, and I am sure the Governor will touch upon various aspects of global and Indian economy and the way forward in his keynote address today. FIMMDA as a market body profusely thanks the RBI for announcing various measures to mitigate the impact of the pandemic and subsequently to moderate inflation without compromising on growth. Measures both conventional and non-conventional have contributed to the financial stability even during these trying times. I will briefly delve into FIMMDA's activities in the last 1 year. As a voluntary market body, we have been functioning for more than 25 years in the development of debt markets, introducing new financial products, enhancing skill development of the market participants are also other activities which FIMMDA is actively involved in. We have a rich and glorious past of contributing to developments of the financial markets. I would focus on some of the insights into the key activities in pursuing and the actions which we propose to take. There is a new products committee of the board which has been entrusted with devising guidelines within the ambit of relevant regulatory instructions, documentation for new products, bringing in required changes in the existing products, analyzing ways and means to develop markets for hitherto non-liquid products after discussion with the market participants. FIMMDA is working toward development of new products also. One area which we have been taking steps to refine the product is the CDS, which came out in 2011, but it did not find so much of traction which the markets as well as the regulators would have wanted to. Now, when the fresh guidelines have been issued on 10th of February 2022, then we have been working for preparing standard conventions, documents formation of determination committee, and rolling out of CDS based on the new guidelines issued on 10th February 2022. We thank RBI for reposing faith in FIMMDA and entrusting us with this responsibility. Other operational aspects and conventions are in final stages of consideration, and the product is expected to be rolled out shortly. I may not be required to go through the entire speech, but I'll only briefly highlight. We have a technical committee for market practices. This committee actively deliberates on practices published by FIMMDA, has been acknowledged to be very useful by market participants in daily operational matters. The document is currently being updated market development. The skill development, which is of abundant complexities, warrant that market. We have 114 members constituting banks, primary dealers, insurance companies, and FIs. FIMMDA has a subcommittee from the board of directors to deliberate and examine upon various facets of membership eligibility. The above are a few of the initiatives which FIMMDA has launched and pursuing its role towards orderly conduct of markets, and also effectively function as a bridge between the regulator and the market session model. The status of SRO would also entrust with FIMMDA the empowered
in the development of financial markets in India. In his opening remarks, Shri Shastri just mentioned about RBI granting SRO status. I would just like to say that you are more than an SRO. So therefore, granting a status on paper would probably, may not measure up to the kind of role in our financial markets and in the way we have been interacting and we have been engaged between the Reserve Bank and the FIMMDA. In my address this evening, I propose to highlight, broadly I have taken the theme of financial market reforms, approach and expectations as the theme of my address today. And I propose to first reflect upon some of the recent financial market developments and our efforts to navigate through them in the prevailing global and domestic environment. I shall then touch upon some of our recent initiatives for development of domestic financial markets and then proceed to conclude by expressing our expectations from market participants and market bodies in the way ahead. Let me first touch upon the recent financial market developments, or more precisely, the recent financial market turmoil. The commentary from the US Fed at the recently held Jackson Hole on the future trajectory of US monetary policy has infused substantial volatility into global financial markets, with large spillovers and knock-on effects on emerging market economies in particular. This episode is yet another demonstration of the point made by me in my media interview on 23rd of August this year, that while forward guidance can be a useful policy instrument in an accommodative monetary policy phase or in an accommodative monetary policy cycle, it can be quite difficult to provide such forward guidance in a coherent and consistent manner, especially when we are in a tightening cycle. The difficulty gets further compounded in the current environment of extremely high uncertainty. Such forward guidance may even have destabilizing effects on financial markets, especially if the subsequent expectations are at variance with the earlier pronouncements. Volatility, especially in times such as now, when global tensions and synchronized monetary policy tightening come together, overshooting often precedes subsequent realignment with the underlying fundamentals. So there are expectations built up, and markets tend to overshoot, and then subsequently when the central bank policy actions are different, or when there is greater realization of the actual state or the actual macroeconomic fundamentals, then of course the necessary correction takes place. So overshooting often happens in such difficult and such complex times. Hence it is useful to take stock of India's macroeconomic fundamentals and its buffers and assess them in the current and evolving conditions. I would like to highlight 6 points in this regard. First, India is widely perceived to be among the fastest growing major economies in the world in 2022, when the other major economies may actually be encountering recession or considerable moderation in their growth momentum. The favorable growth differential of India provides confidence to be reflected in the surge of portfolio inflows into India since eased the terms of trade shock that India faced in the aftermath of the pandemic and the war in Europe. With the consequent easing of imported inflation pressures, India's C per barrel has turned out to be lower than what we had assumed for the full year. As you know, for the full year in our monetary policy, we have assumed $105 per barrel, and the average that we saw, the monthly average in August was $97.4 per barrel, and so therefore that is another positive factor to be noticed. And in fact, India's inflation is currently lower than number of partners. Third, the shift in the commodity price outlook is also altering the assessment of India's current account deficit in 2022-23, that is in the current year, which is now expected to remain well within sustainable levels. Fourth, at a time when food security is threatened the world over by shortage, domestic supply and assure food security in the domestic market and in the domestic segment. Fifth, India's foreign exchange reserves of US $561 billion as on August 26, that is the last published figure. It provides a cushion against external shocks as is being demonstrated on a day-to-day basis. Moreover, the reserves are also reinforced by forward assets. Sixth, the health of our banking system is sound. It is well capitalized and well provisioned with improved asset quality. This constitutes a key pillar of financial stability and is expected to provide positive spillovers for the financial markets. So as you can see, if we are talking of the buffers, or if we are talking of the firewalls which protect our economy or which add resilience to our economy, we have a six-sided buffer or a six-sided resilience built around the Indian economy, and I think these are positives which every financial market participant, I think I would feel that it is necessary to keep in mind. Now, reflecting these fundamental factors, the Indian rupee has moved in an orderly manner in the current financial year so far. It has held, that is, the rupee has held its own in a world of sharp depreciation across the emerging market economies and also advanced economy currencies. While the US dollar has appreciated by 11.8% our financial year, this year so far, the Indian rupee has depreciated by 5.1%, which is among the lowest in the world. And 5.1% is still today, after close of the market. And this depreciation is in fact one of the lowest in the world. The RBI is in the market on a regular basis, providing liquidity and confidence so as to facilitate its smooth and normal functioning. Exchange rate stability is an intrinsic element of our overall macroeconomic and financial stability. Our endeavor amidst the extraordinary events unfolding globally on an ongoing basis has been to anchor expectations and allow the exchange rate to reflect the fundamentals rather than overshoot. Avoiding undue and excessive volatility is a desirable policy objective for all stakeholders, not just for central bank, but I think for all stakeholders and for all participants who are in business or who are in financial market. And this is a desirable policy objective for all stakeholders while reaping the benefits of a market-determined exchange rate regime. As I mentioned that we are there in the market almost on a day-to-day basis, and our approach or our intervention in the market is broadly, as I have pointed out, is broadly premised upon two basic principles. One is to prevent excessive volatility of the Indian rupee, that is the exchange rate. Second, and the second point is that it is also built around the theme of anchoring expectations around, around the depreciation of the rupee. So it is to prevent excessive volatility and to anchor the, anchor expectations around depreciation of the Indian rupee. Price stability provides the anchor for exchange rate stability in the medium run. The flexible inflation targeting regime provides credibility to the RBI's monetary policy mandate of assigning priority to containing inflation and keeping inflation expectations anchored while keeping in mind the objective of growth. While the incoming monthly inflation prints in the near term could be bumpy, we expect it to moderate in the second half of the current year and then move within the tolerance band in the fourth quarter of this year and then move to even lower levels in the first quarter of the financial year 23-24. In response to the pandemic, as you are well aware, the Reserve Bank deployed conventional and unconventional monetary policy tools. The financing conditions were kept benign, they were kept easy. Normal functioning of various segments of the financial market was also ensured. Compare this with, all of you have been in the market for a pretty long time. Now compare this with our experience in the immediate aftermath of the global financial crisis, almost wherein, almost for 10 to 15 days, there was hardly any activity in the market. But this time around, the markets functioned normally, the market infrastructures functioned normally, and it applies to all segments of the market, not just the money markets which we in RBI we regulate. So the markets functioned normally, and this is in sharp contrast to what we had experienced on earlier such occasions. Our communications and forward guidance also at that time provided the much needed clarity and confidence to the markets, both financial and non-financial markets. As we adapted to the pandemic, the policy approach has been gradually normalized. Even as the Indian economy was recovering from the pandemic, it faced a setback from the war in Europe, which caused fresh supply disruptions and accentuated the earlier supply disruptions. Inflation became globalized. Consequently, the response from central banks has been aggressive, leading to synchronized monetary policy tightening across the world. In India, the Monetary Policy Committee reprioritized price stability as the foremost objective of monetary policy and began a process of withdrawal of accommodation. Going forward, our monetary policy will remain watchful, nimble-footed, and calibrated reforms aimed at development of domestic financial markets. So the pandemic, followed by the war over the last 2.5 years, has not deterred the RBI from undertaking reforms. It has been, while we were focusing on these black swan events, while we were focusing on the kind of challenges that COVID and now the war have posed, simultaneously we have not lost sight of the need to continue with reform measures, and we have continued with reform measures, and that is the major point that is an important point which I would like to make. Our approach is based on the principle of adapting to the needs of a modernizing financial market as it integrates with the rest of the world. And I have just, I have picked up 7 reform measures which I would like to highlight. The orderly development of the sovereign yield curve needs significant market liquidity at important benchmark tenor points and supply of G-SECs of various tenors to diverse class of market participants, matching their expectations and matching their investment requirements. To this end, the benchmark security issuance strategy was introduced during 2020-21, under which government securities of specific benchmark tenors of 2, 5, 10, 14, 30, and 40 years are issued. This year, G-SECs with a 7-year tenor has also been introduced after market consultation. I think many of you would be aware there was market consultation on this issue. The next point relates to issuance of green bonds. Issuance of green bonds provides a strong signal of a country's commitment to a low-carbon economy. It also helps in bringing down the cost of capital for green projects. Following the announcement in the Union Budget for 22-23, the government and the Reserve Bank are putting in place a framework for issuance of sovereign green bonds in line with the global standards. The next point is, it relates to the retail direct scheme which we have introduced. As part of our continuing efforts to increase retail participation in G-SECs, the RBI Retail Direct Scheme was launched in November 2021 to facilitate individual investors to conveniently invest in G-SECs, state development loans, and sovereign gold bonds. Further, to ensure liquidity to the retail investor, the retail direct scheme market making was also notified on January 4th this year. The scheme requires primary dealers to respond to buy-sell requests from the retail investors throughout the market hours. Let me move on. The Reserve Bank has continuously engaged in ensuring state-of-the-art infrastructure for trading, settlement, and timely dissemination of information in the G-SEC market. An important initiative in this context is the introduction of the request for quote, that is the RFQ dealing mode on the NDS Home platform in October 2020. The RFQ mode aims to enable market participants to negotiate trades on the NDS Home platform itself for better price discovery. Derivative markets play an important role in allowing entities to hedge their risks and improving liquidity for the underlying product. Several measures have been taken to rationalize the regulatory framework for forex, credit, and interest rate derivative markets. Principle-based regimes have been implemented in the place of prescriptive regulations in a bid to provide greater flexibility and operational freedom to the market participants. Access of non-residents to these markets has also been eased. The access of institutional users to the markets has been facilitated both for hedging and for expressing their views on the market movements. With these reform measures, product due diligence assumes greater importance. It would ensure that market makers offer products that match the requirement of users and avoid exposing their clients to excessive risk. Considering the recent changes in regulations relating to OTC derivatives and in line with international standards, a regulatory framework for market makers in OTC derivatives has been put in place to ensure high standards of governance, risk management, and conduct by market makers. We have also continued our efforts towards integrating domestic and offshore Indian rupee markets. Banks in India with operative IFSC banking units were permitted to access the offshore non-deliverable rupee derivative market in 2020. To facilitate integration of offshore and onshore markets for overnight indexed swaps, which is the most active rupee interest rate derivative in the domestic market, banks in India and standalone primary dealers have been permitted to undertake settlement of OIS transactions with non-residents in foreign currency, and that this announcement was made very recently. Broadly, the recent regulatory and institutional reforms have been aimed at enabling the domestics to face the challenges of the next decade. Cutting across market segments, these reforms seek to usher in a simplified, principle-based regulatory framework that seeks to broad-base markets by easing access, enhancing participation, facilitating innovation, protecting users, and promoting fair conduct. Now we have made a very sincere endeavor to try to synthesize all these objectives and come out with new measures. Now, while I am talking about the reform measures that we have undertaken in the recent years, market has also taken place without any disruption. In response to changes in regulation, and it is never-ending expectation, just as you have never-ending services provided by banks on the FX retail platform also need varying complexity, and also to offer these products only to non-retail and institutional customers who have the ability to handle the risks associated with such products. It has been reassuring to note that market participants and the users have been prudent approach in the use of complex products. The valuation and the risk management systems of the market makers, however, may need to be continually updated. There is no finality in it. It has to be continually updated. Customers also need to be made aware of the unique risks associated with these products. The recent reform measures have facilitated greater linkages of the domestic market with the global markets. As the footprints of banks in India increase in the offshore markets, it is expected that price discovery of rupee products will also consolidate in the offshore market. To realize this potential, banks need to put in place adequate supporting infrastructure backed by expertise in risk management. More so because integrated financial markets can also facilitate faster propagation of shocks which require appropriate risk management processes. Let me now try and conclude. I would like to state that market development ultimately is a shared goal of both the regulator and the market participants. The Reserve Bank has taken steps towards liberalizing market of providing liquidity, contributing to price determination, and easing operational constraints. It is upon the market participants to take the baton forward to develop the market and offer innovative financial products to a broader set of clients. The Reserve Bank will remain constantly engaged with market bodies and participants, market bodies such as FIMMDA in particular. Together, we should remain future ready at all times. I firmly believe that we can do this. And finally, I take this opportunity to wish FIMMDA all success in its future endeavors and look forward to our continued partnership. Just to conclude, let me repeat what I said. Together we should remain future ready at all times, and I firmly believe that we can do this. Best wishes to you all, best wishes to FIMMDA. Looking forward to remaining further engaged and always in interaction between the regulator and the market bodies. Thank you very much.
Thank you, Governor, sir, for that lovely insight of the Indian financial markets. It was very heartening to